Would your law firm's cyber insurance policy cover a fraudulent wire transfer? What if a hacker tricked you or your staff into sending $750,000 to the wrong account? Would you be protected? In this video, I'll show you the surprising gaps in most cyber policies and how to fix them before you're the next headline in the law journal. Stick around because what you don't know could cost your firm everything. Hi, I'm Coyle. For over 40 years, I've been helping business owners and professionals like you navigate the complex world of commercial insurance. And I've seen every pitfall and every costly mistake you can imagine. In this channel, I share the insider strategies and real-world solutions that protect your business and save you money. No generic advice, no industry jargon, just straight talk from someone who's been in the trenches. And if you're dealing with a specific insurance challenge right now, don't wait. Time is usually not on your side. There's a link in the description box below to schedule a quick conversation. I review every request and often respond the same day. All right, so now let's dive into the 4 most critical yet misunderstood coverage gaps that law firm partners and their administrators need to understand when it comes to wire fraud. Gap number 1. You think your cyber policy covers everything, but it doesn't. Yes, most modern cyber policies include social engineering and funds transfer fraud, but that doesn't mean you're fully protected. Here's what every law firm needs, and most don't have, and that's a coordinated strategy between cyber and crime insurance. Your cyber policy should include a social engineering coverage with meaningful limits that reflect the scale of transaction your firm handles. Unfortunately, most policies cap this critical protection to just $100,000 or $250,000, which is a fraction of what's actually needed for even routine real estate closings. To resolve this issue, you need a crime policy that explicitly covers funds held in escrow and theft of funds held on behalf of others, with sufficiently high limits to supplement those in your cyber policy. Another piece of advice is that both your cyber and crime policies must clearly define coverage for client funds. Often, policies only cover your funds and not your clients. Finally, your firm's verification processes must meet the standards required by both the cyber and crime insurance companies. All right, so gap number 2, missing coverage for invoice manipulation and third-party losses. Even if your cyber policy includes social engineering coverage, it likely doesn't cover invoice manipulation, which is a growing threat in today's cyber landscape. Invoice manipulation is where hackers infiltrate your network or your email server and alter or manipulate invoices going out to your clients. That often will direct the payment for services that you've given the client into the attacker's bank account and not yours. The client receives the manipulated invoice, they pay it, and they think they're done. Your firm later contacts the client about their outstanding balance, since you've not been paid, and the client is like, "What are you talking about? I paid that invoice weeks ago." The average claim for invoice manipulation today is over $280,000, so there's a substantial risk to be addressed. And unless you have specific invoice manipulation or client payment and fraud endorsements, your policy may not cover it because the money never touched your accounts. Gap number 3, missing or misfit crime insurance. Here's a common misconception that legal malpractice insurance will protect client funds. It doesn't. Theft or misdirection of funds isn't malpractice, it's a property crime. And that's why specialized crime coverage for a law firm exists. Look for policies that include clear, tailored endorsements covering IOLTA and escrow accounts, theft of funds held on the behalf of others, and so forth. Without these words in writing, a denial is likely. And keep in mind, some crime insurers now also offer social engineering endorsements, which could help in cases of fraudulent induced transfers, as I mentioned earlier. Gap number 4, you didn't coordinate coverage or your controls. Even if you have all the right coverage, claims often get denied due to control failures, frequently related to authentication procedures. Not too long ago, I had a call from a panicked lawyer who suffered a social engineering loss that was over $400,000, and their insurance company was denying the claim because they failed to follow required authentication procedures. He wanted to know what options he had. And I asked, well, what happened? And he said, well, attackers had infiltrated his email account and applied incredible urgency on him via email to wire money over a transaction they had just completed. The attorney then pressured his firm's bookkeeper to expedite the wire transfer because he was under pressure, and they bypassed the required secondary means of authentication altogether. All of this took place in the late afternoon, just before 5 p.m. And overnight, the attorney had this sickening feeling that he was duped. So first thing in the morning, he called his bank to stop the wire, but the money was already transferred and out of his account. Because he was, quote, out of band and didn't authenticate before a wire was sent, the insurer had every right to deny the claim. It's an unfortunate situation, and if litigated, the courts often side with the insurance companies in these cases. So I had to unfortunately tell him I didn't think there was a lot that could be done. Here's a few real-life examples. First, a mid-sized law firm wired $400,000 based on a spoofed email. Their cyber policy had a $100,000 social engineering fraud limit. The rest, uncovered. In another situation, a staff member in a law firm approved a wire after confirming instructions by only replying to the same compromised email thread. The policy required an out-of-band verification. Claim denied. Another firm had cyber and crime coverage, but neither mentioned escrow or client funds. $750,000 lost and no reimbursement. If your policy doesn't spell it out, assume it's not covered. So here's the bottom line. Wire fraud isn't hypothetical anymore. The FBI's Internet Crime Report shows that business email compromise scams caused more than $2.4 billion in losses in 2021 alone. Law firms are a prime target because you handle high-dollar, high-trust transactions every day. Don't wait until you're the next headline. Take 10 minutes today and review your policies. Do you have social engineering fraud coverage? Are client funds, especially those held in escrow, clearly protected? Do your internal control procedures align with your insurer's authentication requirements? If you're unsure, or you want help coordinating your cyber and crime insurance, my contact info is in the description box below. And as I said earlier, I've been helping firms like yours for over 40 years. This is what we do. Finally, if this video opened your eyes to coverage gaps you didn't know existed, do me a favor and hit that like button and subscribe. Share this with a colleague. You may save another firm from a devastating financial loss. Have any questions? Drop them in the comments below. I read every one of them and respond to every one of them. Thanks.